Good afternoon and welcome. My name is Lori Goodman, and I'm the co-director of the Housing Finance Policy Center at the Urban Institute. I want to thank all of you for joining today for our data talk entitled Fintech, Who Does It Serve? Who Can It Serve? We're going to discuss the role of financial technology, or fintech, in the financial services markets with two esteemed and knowledgeable experts. Each of our experts has written a very thoughtful paper on this topic, addressing different aspects of the issues. And you can read their bios in your handout. I encourage everyone in the audience to continue our dialogue by sharing your thoughts or observations on social media using the hashtag #LiveAtUrban. Please include the speaker's Twitter handles, which are displayed on today's agenda. I want to also welcome our virtual audience watching over the webcast live stream. If you're tuning into the webcast, please submit questions to events@urban.org, that is events@urban.org during the program, and our staff will filter those to me. I'm happy to introduce Tomasz Piskorski of Columbia Business School, who will present his findings on fintech and regulatory arbitrage in mortgage lending. Then you're going to hear from Todd Baker of Harvard's Kennedy School, who will discuss fintech as a promising alternative to short-term small dollar credit lending serving low-income working families. Each of these talks is going to be about a half hour. After both of our speakers present, we're going to open it up for questions from the audience and for online viewers as well. That is, you can ask clarifying questions during the presentation, but hold anything substantive until the end. Our next Housing Finance Policy Center event, jointly sponsored with our CoreLogic friends, is going to be a sunset seminar on April 11th, right here in this room at 5:30 p.m. We're going to focus on resilience in the face of disaster, risk, mitigation strategies, and recovery. With that, I'm going to turn it over to Tomasz to kick us off. And again, I'd like to thank both speakers for agreeing to do this presentation today. We're very much looking forward to it.
Distribute it at some point. Put it on the.
So thank you for having us here. I just want to thank Lori Goodman for setting this panel together. And welcome to everybody who is here, and welcome to everybody who listens to us online. So I want to talk about fintech and regulatory arbitrage in the mortgage lending market. Just want to say this is largely based on my joint work with Greg Buczak from University of Chicago, Gregor Matfos from University Texas at Austin, and with Amit Seru from Stanford. If you want to see more details on what I'm going to talk about today, our paper is available for free download at this link. So let me tell you what motivated our work. There are two important trends in the residential mortgage lending market after the crisis. The first trend showed on this picture. It shows that traditional banks are retreating from residential mortgage business. So in 2008, less than 30% of loans were made by non-banks. By now, more than half loans are made by non-banks. So in other words, Bank of Americas of the world are much less likely to make residential loans than they used to in the past. The second trend is that there is a growing share of residential mortgage originations made by what we call Fintech Lenders. These are essentially non-bank residential lending companies that very heavily use online technology. I'm going to be very precise what I mean by that. But they currently account already for more than 10% of newly originated loans in the United States, and their share is rapidly growing over time. So what we want to do in this paper, we want to understand what are the potential mechanisms behind this dramatic shift in the residential mortgage lending market. And there are at least two things that come naturally to mind. The first thing is regulation. We know that after the crisis, we had a very big increase in various regulatory action, scrutiny, laws being passed, and so on and so forth. I'm going to be more precise about it later on. But essentially, the idea is it could be that traditional banks are withdrawing from the residential lending business because they face more regulation, more costs, and they're just being replaced by non-bank institutions that we'll call shadow banks. Just you could think about it as non-depository lending institutions, and some of them are these fintech lenders. And an alternative explanation is that it also has to do something with technology, especially for the fintech lenders. In other words, it is possible that this online origination technology and big data allows fintech lenders to lower the cost of originating mortgages. Maybe it allows them to operate with more convenience for borrowers. And also the access to big data maybe allows them better pricing of these loans. Let me give you an analogy that I think we can all relate to. Think about Uber versus traditional taxi business. Why Uber becomes so popular? Some of that could be with regulation. We know that especially in places like New York City, Uber faces much lower regulatory regime that allows them to potentially cut costs. So as they become cheaper, they become more popular. But undoubtedly, the Uber also can be more convenient. You can order the car online. You don't have to wait and try to hail a cab on the street at night. You don't have to pay with your credit card when you get dropped, at 10 p.m. in front of your house, and so on and so forth. So it's probably the rise of these market disruptors, think Airbnb or Uber, have to do something both with regulation and the potential convenience. And a very similar forces could be present in the consumer finance market. So our objective is just to look on these trends in the residential mortgage market and understand what could be drivers of this retreat of traditional banks, and in particular trying to understand to what extent it has to do with regulation and financial technology as being the driving forces of this trend. I just want to say that residential lending markets should not be underestimated. It's roughly a $10 trillion market, which is essentially the largest consumer finance market in the world. So this is really a very, very big market with tremendous amount of origination volumes every year. So how are we going to go around it? So first of all, we want to shed light on, yes?
Home lending or consumer lending, what constitutes $10 trillion?
It's residential mortgages in US, outstanding. Yes. So first, we're going to shed some light on the effects of regulation. And again, though the talk is about fintech, we'll argue it's very hard to understand the growth of fintech lenders without also understanding the regulatory regime in which they operate. So first, to understand the role of regulation, we're going to just compare the traditional banks to all shadow banks, including fintech lenders and non-fintech lenders. That would allow us to sort of exploit the differences in regulatory regime and try to just understand to whom these banks are lending, how the relative shares evolve over time, in which regions the non-bank lenders are more active than traditional banks, and so on and so forth. To isolate the role of technology, we will compare non-bank fintech lenders to non-bank non-fintech lenders. That will allow us to keep essentially a regulatory regime constant and tease out the potential benefits of an online origination technology and the impact on pricing, on the type of borrowers being served, and on the general evolution of market trends in this space. And we'll also have a simple kind of quantitative framework that would allow us to say something about the relative importance of regulation and financial technology in explaining this retreat in traditional banks in the residential mortgage business and a big, rapid increase in what we call the shadow banks, and especially the fintech lenders. So in terms of the roadmap, I'll do some data definitions. Then I'll talk about some basic facts on shadow banking and fintech loans. Then I'll try to present some evidence that speak to the relative role of technology. Then some evidence that speaks to the relative role of regulation. Then I'll follow with evidence that speak about the relative role of technology. And I'll finish with a simple quantitative model and some conclusions speaking to various issues, including policy issues. So first, in terms of data, we use a variety of data sets. The first one is the data which some of you might be familiar with. It is, I have some problem with this. Just go back quickly. Yeah, give me a second. Do we have like, yeah, I'm sorry, I just have a little bit. It doesn't really. I'm almost there. Give me a second. Yeah, I'm almost there. Sorry for this. Apologies for that. So the first data set is from Home Mortgage Disclosure Act. It's essentially data on all universe of residential mortgages originated in US. What's great about it, it has information like race, the name of the lender who originates the loan. Unfortunately, it doesn't have a data on dynamic loan performance. The second data comes from Fannie Mae and Freddie Mac. This is essentially the monthly panel data on origination characteristics and performance of residential mortgages. We also complement it with similar data from Federal Housing Authority. And we also combine it with some data that captures the regulatory and financial constraints faced by traditional lenders, think by Bank of Americas of the world. And we also complement it with a census data that captures information on things like county-level demographic trends, like unemployment, access to the education, access to internet, and so on and so forth. So let me first tell you a little bit about classification, because this is important. To classify banks as traditional bank is fairly straightforward. We're essentially talking about depository institutions that has access to deposit financing, usually insured, for example, by FDIC or credit union insurance arrangements. So this is fairly straightforward. Bank of America or JP Morgan will be a traditional bank by this account. Any other institutions, the non-bank lenders, we call them shadow banks. These are essentially institutions that don't collect deposits. They don't have a depository base. These deposits are not insured by anybody in case someone gives them the money. Obviously, the kind of a harder part of our analysis is to distinguish fintech lenders from non-fintech lenders. So what we do, we identify a lender as fintech if it really uses a heavy amount of online origination technology. I'll give you a precise example what I mean by this. But for all practical purposes, it means you can pretty much went through entire loan application online without any interaction with a human, and you get a firm rate offer. So at the end of you go through the app, and at the very end, the app will tell you, yes, you are approved for the loan, your interest rate is 4%, 14 basis points, and you have a certain amount of time to close. But there was literally no interaction with a human being through this entire process. So what we really did, we have a number of research assistants that went very carefully through various websites, application procedures, and essentially classify traditional banks. Again, it's very easy to classify them, but classify non-bank institutions into fintech and non-fintech lenders. Now, let me clarify one thing. We have not found during our sample period an instance of traditional bank using what we call a fintech technology. So fintech technology is, during our sample period, the way we define it, exclusively present in non-bank, the so-called shadow bank lending institutions. There was no traditional bank that was using the fintech technology during our sample period. I've actually had some interaction with some senior people from the banking business, and they agree that this sort of observation is entirely accurate. So let me give you an example. So for example, if you go to a non-fintech shadow bank, obviously everybody has a website, and you can initiate an application process for a loan. But what is very important is, in the case of a non-fintech shadow bank, you will usually be assigned a human to interact with. There will be some loan specialists who you will have to, you'll be assigned a loan processor who works with you through your closing process. You usually have a number of phone conversations. You have to send some documents to someone. So it's not really that different from the traditional bank lending business. You might have a website. You might do some additional initial steps in your application, but at the end, you'll have to interact with human. Somebody has to review the documents. You'll have some back and forth with a human being that will at the end tell you whether you got a loan or not. Might tell you by email, but it's still not as technological as fintech lenders. If we think about If we think about fintech lenders, the perfect example is Quicken, which is by now I think the third largest lender in US in the residential mortgage space. And I have this product called Rocket Mortgage. The name is Rocket because you can get a mortgage as quickly as, as a rocket that takes in the sky. And if you see the application process is very different. You literally have an app and you just can fill it. You can do it, at 3 a.m. on Saturday, and you can just go through a number of steps in this app. It will ask you, what do you want to do? Do you want to get a new loan, or do you want to refinance your existing loan, and so on and so forth. And at the end, you will see something like that. You will see a page that essentially says you were approved, and this is your rate offer. You got, in this specific example, your interest rate is 4.12%, loan type is 30-year fix, you get some discount points, there's some new loan amount is $211,000, and so on and so forth. But essentially, you obtain a loan within a few minutes by giving things like, your social security number, some information about additional loan characteristics. Of course, occasionally they might send someone to verify your collateral, a person that, but the terms of the loan has been really given to you online without interaction with any human being. So let me first review again quickly some basic facts on the decline of traditional banking residential mortgage business, especially focusing on this role of shadow banks and fintech lenders. So first of all, I've already shown you this picture. So currently, there's been increase from 2007 in the number of loans originated by non-bank institutions. Currently, they account for more than 50% of newly originated mortgages in US. They are not done by traditional banks. And you can see it in conforming loans. This includes loans by Fannie and Freddie Mac, guaranteed by Fannie and Freddie. You can see that there was a really rapid growth. And now more than half of these GSE loans issued with guarantees from Fannie and Freddie Mac are originated by non-bank institutions. And in FHA space, currently about 80%, in 2015 it was 75, but it's still growing. Essentially 80% of loans guaranteed by FHA are currently issued by non-bank institutions. So for all practical purposes, traditional banks essentially handed the keys to the FHA market to shadow banks.
Are you talking about number of loans or dollar amount?
This is the number of loans. If you do dollar amount, you get very similar pictures. There's really very little difference. So, and if you look on the importance of fintech lenders in the shadow bank lending boom, it's really rapidly growing. So in 2007, for example, in conforming loans, Quickens of the world were pretty much non-existent. By now, about a third of this shadow bank lending is done by the fintech lenders. So first, let me also tell you a little bit few basic facts in which segments shadow banks and especially fintech banks are present. Obviously, that will already start telling us something about regulation, technology, and so on, in which corners of population these lenders are active and in which regions. So what we find out is, first of all, in general, shadow banks are more active in areas that have more minorities. And obviously, high minority areas are usually also on a number of economic factors riskier. So this is what we see. Interestingly, there is an interesting dichotomy. In general, shadow banks are more active in high minority areas, but if you look on shadow banks that use fintech technology, that's not the case. They tend to generally be less active in non-minority areas. So it's not the case that this online lending really just looking on this basic statistic, it doesn't suggest it democratizes the credit and makes it available to minorities. If you look at FHA market, it's essentially dominated right now by shadow banks, which is consistent with regulation being an important driver. Just to remind you, the FHA is essentially the riskiest loan pretty much right now you can make. It's guaranteed by government, but it's a loan that you can get with 3% down payment. So think about it. The most riskiest corner of the market, the FHA loans, which are predominantly taken by less creditworthy borrowers, minority borrowers, and insured effectively by taxpayer, are currently, this market is fully dominated by lightly regulated non-bank institutions. Traditional banks like JP Morgan's, Bank of America is pretty much checked out from that market. So that already suggests that there's something with regulation might have to do with that. And in general, shadow banks are also more active in high unemployment areas, but again, this is not the case for fintech shadow banks. So just to kind of sum it up based on this, shadow banks in general go to the areas which are riskier and so on, but on the other hand, fintech lenders, that are also shadow banks, are not really as active in these high-risk areas. In terms of purpose of the loan, fintech lenders are particularly active in refinancing. 75% of loans they make are refinances, and it kind of makes sense. They potentially piggyback on the original loan, like someone already made a loan to a person, so it's potentially more convenient for online originations to refinance an existing loan than originate fully a purchase loan that might require more physical presence and physical checks. In terms of loan financing, shadow banks rely very heavily on government guarantees and ability to sell loans with government guarantees relative to traditional banks. Just to show you, the most important part of these pictures is blue and red. Blue essentially tells you how many loans you retain on bank balance sheet in the year of the loan origination, while the red tells you how many of these loans you sell with guarantees of Fannie and Freddie or with FHA guarantees. And traditional banks still retain substantial portion of their loans on balance sheet. Many of these loans are, for example, jumbo loans. If you look on fintech lenders, they essentially by now pretty much sell everything. They have a little bit of balance sheet retention, but it's not very, it's not very substantial, and it's probably just an inventory that was going to be sold later on. So it's kind of obvious looking on this picture that government guarantees and ability to essentially securitize these loans and sell them is very important for these lenders. And sort of also not surprising, they don't have any depository base, and they really rely on ability to sell these loans quickly, and in particular government guarantees to do that. So now let me tell you a little bit about pricing of these mortgages. That will tell us a little bit about this idea, why we see this growth in the shadow banks, in particular in fintech lending. So one hypothesis could be they're just cheaper, and because they're cheaper, they charge lower rates, and because they charge lower rates, the borrowers prefer them. They can be cheaper because of cheaper costs of capital, cheaper origination costs due to this online technology. So when we look on the pricing of these loans, what we essentially find is that non-fintech shadow banks pretty much charge similar rates to traditional banks. They're slightly lower by about 3 to 5 basis points, but it's not a very big economic difference. Interestingly, fintech loans are always, statistically speaking, controlling for all observables are usually 14 to 16 basis points more expensive. And it really holds across the entire period. I checked the websites of the lenders. This is a very robust fact. So just to put it in dollar amounts, given the typical loan balance, let's say of $200,000, we're talking about $300 more mortgage payments per year on fintech loan compared to very similar loan made by traditional bank or by shadow bank. So generally, these fintech loans are not cheap. They're usually a little bit more expensive. Performance, shadow bank loans default slightly more, but since there's not as much defaults in our sample, these are newly originated loans, it's hard to say about the magnitudes of these effects. And shadow bank loans also are much more likely to prepay, especially the fintech loans, which is consistent with this. These fintech lenders are very aggressive to incite you to prepay, and they immediately sell this loan back to the financial market. So let me show you a few things about the regulation. This is a map of US and the presence of shadow banks in 2008. This is what happened by 2015. It's become much redder because shadow banks are like spreading out in many regions. So what we essentially do in the first part of the paper, we use ex-ante presence of traditional lenders to understand whether shadow banks, including fintech lenders, particularly expanded lending in areas when traditional banks face more constraints, either because they have to rebuild their capital buffers, either because they face more lawsuit area settlements, or either because they have a large share of mortgage servicing rights, which under the recent regulation are not really counting as much towards high quality capital for regulatory reasons. So you can think about this test like we take the ex-ante presence of traditional banks and we try to understand, is it true that shadow banks particularly expanded in areas when traditional banks face more constraints? The constraints were faced at the national level, but say if there is bank A that particularly is endangered during the crisis, we look at areas when this bank was present to understand, is this the area when traditional banks are retreating? And just in the interest of time, let me just tell you that, let me go quickly over this, that essentially this is what we find. We find that indeed, there's a very strong evidence that in areas when traditional banks face more constraints, this is where we see the shadow bank growth. And the magnitudes are fairly substantial. So let me skip this quickly. These are just a bunch of tests that sort of speak to that. Now, in terms of the, so this evidence suggests that definitely the regulation is an important driver of this expansion of non-bank institutions, the shadow banks. And that also applies to fintech lenders. You know, it suggests that the fact that traditional banks were facing more constraints due to regulation and due to the need to rebuild the capital buffers, it suggests it has to do something with the expansion of non-bank lenders. Now, in terms of technology, now we can dance alone on Saturday at 3 a.m. as opposed to go to traditional banks or non-fintech shadow banks and do all this paperwork. It could also be clever marketing. Consistent with this, we actually find that the fintech premium is the highest for the most creditworthy borrowers, but also have probably high shadow costs of time. So it's not that fintech lenders are cheap and they credit cheap, and it's also not the case they make credit particularly available to minorities. Of course, it's also demand supply. It could be that minorities are not very comfortable with this sort of online application technology on average. It simply looks like these fintech lenders serve mainly most creditworthy borrowers, mainly people who want to refinance their loans, and they charge a premium for that. The second thing we also look is to what extent there's evidence that fintech lenders use different models than traditional banks. And what we did essentially, we look on the evidence to what extent traditional observables like FICO credit score, interest rate, a loan-to-value ratio, FICO credit score explains the variation in interest rate charged by lenders. And essentially, I just show you this picture. What it really shows is that fintech interest rates has much more variability above and beyond traditional observables compared to both traditional banks and non-fintech shadow banks. The way we interpreted it suggests that fintech lenders either use additional data that traditional lenders don't use. It could also be some clever use of various marketing strategies and what kind of rate you get shown at a given point of time and so on and so forth. So let me finish. I have about like 2-3 minutes. We have a very simple model to kind of make sense of these facts. I'll go quickly through this, but essentially in model you have borrowers, what the borrowers want. They want as low interest rate as possible. They value specific lenders based on the identity of the lender. Maybe you like Bank of America more than Quicken because you like to interact with a local branch. And there's also some borrower bank specific shock. It's a kind of a traditional IO model of lending. We allow in this model 3 types of lenders: bank, traditional banks, non-fintech shadow banks, and fintech shadow banks. And they differ in terms of the funding costs, in terms of the operating costs, and in terms of the regulation. And we sort of calibrate this model. Let me skip the details. We calibrate this model to data, and we try to decompose to what extent the growth of shadow bank lending, including the fintech lenders, has to do with technology and to what extent it has to do with regulation. Without going into details, let me give you the key intuition what this framework really does. The key thing is to combine both changes in market shares and interest rate pricing. Let me give you the one obvious hypothesis for why shadow banks are expanding their lending business is that they are cheaper. So we should see an increase in the share of non-bank lenders in an economy, and at the same time we should see that the interest rate they charge relative to other lenders is lower. On the other hand, if we see an increase in the share of shadow banks, and especially of fintech lenders, and we don't see that they achieve this increase by charging lower rates, something else must be changing, and this something else can be the technology or regulation. So when we calibrate the model to data, and I'll finish in a minute or two, this is what we get. So first of all, the simple quantitative framework tells us it is not the case that shadow banks have a cheaper funding cost. In fact, they have higher funding costs relative to traditional banks. And then it makes sense. Bank of Americas of the world probably have much better access to capital through cheap deposit financing and so on than shadow banks. So what explains? So if the traditional banks have actually cheaper funding costs, how come they are retreating from the business? And this is the calibrated regulatory burden. Just to explain you this picture, the higher the level, the easier for traditional banks is to lend. So it's kind of the inverse of regulatory burden. High index means the banks face less constraints. And what's interesting, the model pins down a very important date, 2011. This is the moment when regulation faced by traditional banks and capital constraint starts tightening. So essentially what this calibration tells you that till 2011, traditional banks were kind of rebuilding the market shares. Something happened in 2011 when the regulatory constraints of banks have been tightened. Not to read too much into it, but remember the Dodd-Frank, Consumer Financial Protection Bureau, changes in Basel regulation all happened after 2011. And the final picture is that if you look on lender quality, we find out that in general, both relative to traditional banks, fintech and non-fintech offer lower quality to borrowers, which is not surprising. They don't offer you deposits. They don't offer many services. But what's important, the fintech quality has been growing over time, and that explains the growth of fintech lending. So we do some counterfactuals to understand which of these matters, and essentially what we find out that 70% of the growth in shadow banks is due to regulation, especially tightening regulation after 2011, and 30% due to technology. So let me finish with the last slide, just to kind of wrap up. Give me a second. So we have three sort of conclusions. First, regulatory arbitrage seems to be the dominant force in the retreat of traditional banks from the residential mortgage business. From the policy perspective, one worrying thing in this regard is that we essentially handed the control of the riskiest segment of the residential mortgage business, the FHA loans, to the very lightly regulated institutions. And these institutions are writing an insurance on our behalf because all these loans are effectively insured by taxpayer. So that's one thing to think about. Second, we don't find evidence in this space that technology helps to democratize credit or make it widely available to minorities. Instead, we find that fintech lenders in this largest $10 trillion consumer finance market, they mainly focus on more creditworthy borrowers. They mainly focus on simple things like loan refinancing. And the borrowers are willing to pay a premium for that, especially high creditworthy borrowers, which is sort of consistent with this idea they just offer more convenience. And some borrowers are just willing to pay for that. And the third thing is what I just said, is we find that the dominant role is the regulation, but technology still explains about 30% of the growth of non-bank institutions in the US. Thank you very much.
Good afternoon. I'm Todd Baker. I'm a senior fellow at the Masfar Rahmani Center for Business and Government at Harvard Kennedy School. And thank you to the Urban Institute and Lori in particular for inviting me to share my results with you today. Let's see. Oops, there we go. I apologize, I didn't put a link to the study itself, but Lori says she's going to put that on the website if you're interested. So we started out with the view that low-income working people were in a bind in terms of liquidity solutions. And current credit practices, particularly around the payday loan industry and bank overdrafts and stuff, were making their situation worse. We spent a lot of time looking at the what's and the whys. Why are low-income working families financially stressed? What stresses them? What products are they using today to deal with that stress? You know, what's causing the damage with those products to the families, to communities? What's the impact of regulatory interventions? Commonly asked question, why don't the banks help? And with the view that political developments meant that it wasn't likely that much help was going to be coming from the US government anytime soon. So we had a hypothesis that financial technology might be able to play a role in fixing the current system, although we had no illusions that finance or financial technology could solve the underlying problem for low-income folks around income distribution and the gradual impoverishment of the working class in the United States. But it was clear to us that today's solutions were doing more harm than good, and new alternatives were desperately needed. So we hope that what we would find is that there were new approaches coming out of fintech which would be useful. So we focused our research on what we call short-term small dollar credit, or STSDC, because we couldn't say the long thing for an entire 6-month period. So we defined that as general purpose consumer credit, in other words, not for the purchase of particular goods or car or house. Very short term, 9 months or less, and in amounts between $50 and $2,000. And we were focused on this because we believed that this type of credit was being used to deal with essentially day-to-day cash flow problems. So that meant payday loans were in, auto title loans, which are essentially another form of payday loan, bank overdraft fees, to a lesser extent pawn loans, and deposit advance products, which were bank products associated with, similar to payday loans. We excluded a lot of other types of high-cost products, which you'll see listed here. I won't go into that. And we focused on the defined group of low-income working families, which was those families earning less than 200% of the poverty limit, which in 2016, which was the data we used, was about $48,500 for a family of 4. And those families make up about 32% of all American working families, and about 70% of low-income families were classified as working families. And so if you look at who's in that group, you know, a lot of it is focused on 8 occupations: cashiers, cooks, health aides, janitors, maids, retail salespeople, waiters and waitresses, and drivers. Some of those were fast-growing, particularly the health-related ones. Cashiers was the #1 group in 2011 where we got this data. And coincidentally, cashiers, drivers, and retail salespeople are the people most likely to be displaced through technology. If you've been to your CVS recently, you'll understand that. So what do low-income working families use short-term small dollar credit for today? Well, mostly they use it to pay day-to-day household bills. So 42% of them are using to pay utility bills, 41% borrowed for general living expenses such as food. And the top 4 reasons that a FSI study recently noted for the use of STSDC were a timing mismatch. A bill was due before the paycheck was in. Unexpected expense, medical copayment, car breakdown, etc. Negative cash flow, which is the one that no finance outcome can help, which is general living expenses exceed income on a regular basis. And an unexpected income drop, which we'll talk about shortly. Lost job, hours cuts, benefits cut, etc. What did we learn? We learned that income volatility as opposed to expense volatility, which was the traditional way of thinking about volatility in households, was increasing. I'm sure you've all seen the studies on this, but basically the JPMI study, which we used, showed that in 6 months of the year there was a variance of more than 10% in either direction, and the expense and income variances were not correlated. What were the causes of this? The biggest cause was an irregular work schedule, and the way to think about that is, you know, the scheduling software that retailers use very frequently now, where you might have 60 hours one week and 20 hours the next. Followed, you know, bonuses and commissions, which have been driven down to the lowest level of employees. Obviously, periods of temporary unemployment and seasonality also go in. So JPM's study showed that if you were in the first 2 income quintiles, which is roughly the same as the group we were looking at, you would need between $1,600 and $2,800 in liquid savings to handle the normal variance that you'd see in your income and expenses, but you had typically less than half of that available at any time in your checking account. And you're familiar with the usual statistic that only, about a third of the U.S. households don't have $400 to deal with any kind of emergency. So I won't go into the back and forth over the negative impacts of the payday loans and others, but basically it's pretty clear that a cycle of debt is real in that case, and that there's substantial negative effects on the people who become dependent on those solutions. So one thing we learned, which was quite significant, was that employers are also hurt by this level of financial insecurity that is faced by low-income employees, particularly large employers who tend to employ a lot of low-income folks. And I've used retailers and Comcast and a few others here as examples. But productivity, there are a variety of studies showing impacts on productivity. We're going to talk a minute about increased turnover, which is a very significant issue, absenteeism, pilferage, and just general difficulty in dealing with distracted employees who have to try to run out to the payday loan place at lunch to deal with a financial emergency. And we also learned that there's really a huge addressable market for any solution to this problem, because you have about 65 million Americans, or about a little over 40% of total wage earners are in this group, earning between $15,000 and $50,000. And it appears that most of them work for very large companies with over 500 or 1,000 employees. So our seat of the pants view was that if we could reach 15% of the workers employed by large companies, that would be 8.25 million employees. And if we could do 40%, that potentially 22 million people could be affected by any positive change in the current system. Of course, we looked at the regulatory situation, and you're all quite familiar with that. I'm sure that the policy interventions in this area haven't had a great deal of effect. The whole CFPB effort to try to regulate payday and auto title lending is in jeopardy, and the state law efforts driven primarily by the Pew efforts have had spotty impact, and aside from situations where it goes to a plebiscite, which typically payday lending loses plebiscites. But why is this a real concern, a legitimate concern about limiting forms of credit which so many Americans are now dependent? Very successful industry lobbying efforts, which appear to be getting more successful here in the U.S. and the federal government. And what I would call the balloon effect, which is it tends to be product by product regulation, and so you push down on one of these products, the need is still there, and a new solution pops up equally abusive. Why aren't banks the answer? Well, banks have had a long and inglorious history of trying to move down scale into high-risk consumer lending. There have been several, if you look at the historical record of the 20th century, you'll see several times where they did. It's usually ended badly. Subprime lending is usually justified strategically as having a good return through the cycle. What that means is a high return early in a credit cycle, very, very low return or negative return late in the credit cycle. Very rarely do you find banks having gumption to deal with the downside of the credit cycle. So they typically enter, if they enter at all, early in the cycle and get out as soon as there's a sign of trouble. That doesn't lead to any kind of consistent solution. Plus, and we shouldn't underestimate this, banks have an enormous financial interest today in the overdraft system, which is a way in which many consumers who don't go the payday route just go the repeated overdraft route to deal with short-term cash flow problems. Banks, one of the oddities of the situation that we face today is that the Durbin rule took away a big source of revenue for bank branch systems, and made reliance on both high-income customers and low-income customers, important for banks because the broad middle market customer was no longer generating significant debit income. And one of the consequences of that is higher reliance by banks on overdrafts. But the banks are not likely to be the solution. They've been forced. Yeah, sure.
Are you talking about the Durbin interchange?
Yes, so that has to do with debit card fees. And essentially, the bank branches prior to Durbin had a distribution of revenues associated with wealthy or people who were using lots of different products of the bank. They might be wealth management customers. They might be taking out loans. Low-income customers were largely a cost for the bank because the cost of providing DDA services is quite high, except they generated some NSF and OD overdraft fees. But the middle market customer who had some products and some overdrafts was really being supported by debit interchange fees when they were, their checking account expenses were being covered by the fact that they were using the debit card and generating significant revenue. But for any bank over $10 billion today, that source of revenue has largely been made irrelevant. And so the banks have generally gone to a product strategy of focusing on the high-end customers, and they're supporting more of the branch costs through higher interchange fees. Although there has been political pressure, which has changed some of the practices there. But Durbin, by and large, was very bad for universal retail banking distribution, and took away a big piece of the revenue piece that was supporting checking accounts for the people. So we concluded that private sector alternatives, particularly fintech alternatives, might offer the best opportunity to help people manage their day-to-day finances without resorting to payday lending. So what we did is we looked at a whole universe of, I'll go through here, whole universe of fintech companies. And we classified them into a variety of categories. The first is what we call digital credit access cost improvement lenders, which are lenders who are trying to provide some equivalent to short-term small dollar credit, but on better terms, lower prices, perhaps with a road to improving your credit rating so that you can get more traditional forms of credit. You might be familiar with LendUp and Elevate. Those are two companies in that category. There were a whole bunch of folks doing credit builder and digital credit building, or trying to, where they were trying to help folks either by lending to them in a way that they could easily pay off the loan and therefore improve their credit rating, or just doing things to try to change their behavior in ways that improve their credit ratings. We had a whole variety of people doing what I call digital financial and cash flow management software solutions. It's a long way of talking about apps that essentially were providing behavioral finance-based financial management advice, so that would, if you put your financial life on the app, it would advise you as to when to pay off your loans, how to arrange your financial life, how to understand how much available to spend you had at any particular particular time, given your the timing of your various obligations. All digital banks, it's a growing group, but these were not actual banks, but they were providing checking account type services through arrangements with other banks, but with a superior mobile solution, and often with things like financial management software attached to them. The most interesting category, digital income expense variability management, which were companies which were trying to come up with new ways other than lending money in a traditional sense to deal with the income expense variability. And last, there were a variety of mobile savings apps that were trying to either through traditional methods or through behavioral methods to try to increase the ability of low-income folks to have liquid savings to use to deal with income and expense variability. So as I said, we talked to probably 30 founders and interviewed all these folks about where they were. It's quite interesting. This was done just about a year ago, And there's already been a number of these folks are gone. Some have moved categories because there's a lot of adaptation in this area. So I would say, for instance, in the consumer bank, B is gone. Even Responsible Finance has moved over one category and is now a cash flow management app. Ascend in the bottom of the digital credit access area is gone. And you would see, new companies that have come in this space as well that we didn't look at. So how do we decide whether these things were good? We looked at what we called utility, which was, did they provide a superior substitute for current products in managing the factors that lead people to use payday loans and other short-term credit, or did they provide an effective mechanism which would allow consumers to actually avoid the need to access credit at all? Could they manage to help people arrange their financial lives so they wouldn't need to rely on credit? Equally important, we looked at scalability because a lot of these companies had a good product but no real business model. And so we were looking at the potential for the business model to support rapid penetration and ultimately serve a large proportion of the population. So I won't go through this in detail, but we assessed each of these categories in terms of the potential and how many people they could serve and whether they could meet these short-term needs or avoid them, and you can read that at your leisure. And we reached some general conclusions. First is that private sector adoption of some of these alternatives could shift a significant portion of low-income working families away from their current reliance on payday, auto title, and damaging things. Fintech products taken alone or in combination with each other appeared able to deal with the negative monthly variances in income and expense that we had identified, and that it appeared that they could potentially benefit virtually all of the 10.5 million low-income working families and the 50 million or so members of those families without, importantly, government financial support or new regulations. So we also concluded, and this is really I think the biggest takeaway, is that the employer channel is the best vehicle for the dissemination of these types of products. It has superior scalability and some potential for subsidization, and I'll explain why employers would be willing to subsidize these things in a minute. Oops, what did I do? Okay, I'm not going to go through these in detail. I'll just go look at this one. So we looked at the various categories. We came up with two that we thought were the most impactful. The first was the income expense variability solutions. They provided the least expensive and most immediately useful substitute, and also looked like they could be the center post of a collection of these capabilities that could help people improve their financial health. And then we also felt that there was potential in the digital credit access cost improvement lenders, subject to some important caveats. One is that they actually were able to deliver on their promise of helping people migrate into the more traditional credit functions, credit cost areas, and that they dealt with there was potential scalability issues because many of these companies were sort of cherry picking from the best of the folks in the low-income working family category, and because of that, they might not be totally scalable. And they also have a funding issue, which is they're largely funded in the capital markets, and so there's a high risk that they will exit markets just when they're needed the most at the time of a financial downturn or a market disruption. Oops. This is a picture version of this in terms of utility and scalability, and these are the two categories that we thought were the most impactful. We also felt here that the employer-based platforms, anchored by the expense variability management apps, but adding these other characteristics, would be scalability and would provide adequate revenue for these companies to succeed while also helping their customer base. The next pictures are just, this deals with the conundrum of the cost improvement lenders. This talks about the fact that the digital credit builders really don't have a business model and need to migrate some way into being included in other solutions in order to be able to survive. And the general point is combining many of these companies and their apps, particularly tied around some of the financial management software, which helps people manage their lives, and the expense variability management, would likely provide a significant base for revenue positive companies that could survive in the market. So, recommendations. Employers should adopt and subsidize employee financial health benefit plans. The intermediaries who are very active in employment benefit area should support adoption of these plans. Fintech companies should broaden their offerings to include a number of these capabilities because that's likely to be the most successful model. Non-fintech companies like banks should adopt some of these fintech products to serve their own customers. Data governance, a big issue here for any fintech, but equally important here. There has to be a resolution of this data governance issue, and I'll talk about that in a second. Nonprofit sector should advocate for this and perhaps use themselves as test areas. Public sector employees should adopt these plans as well. Think about the military. This would be extremely helpful in the military, which has been struggling with the problem associated with predatory lenders surrounding the bases. And there are some public sector legislative regulatory actions that could help around data governance, around perhaps tax credits for some of this activity. But fundamentally, it can be done without significant government intervention. So some subsequent research that we've just done on two of these fintech companies, one of which PayActive was in our original study, and the other, Salary Finance, doesn't really fit our categories. It's a UK-based company. So PayActive is one of the ones that takes, you have a 2-week delay between when you do your work and when you get paid. And PayActive allows you to access your earned but unpaid wages for a very low price, often subsidized by the employer. It's provided through the employer because PayActive is able to recover the amount that has, it's able to access the time and attendance system of the employer, and therefore to know how much you've already earned and will be paid eventually, and so it's able to calculate how much it's willing to advance you based on that. It's really not a credit advance because it's essentially guaranteed. Right now there's a trial we'll talk going on at Walmart with PayActive and Even, but the PayActive product is the core of it. They currently charge $5 per use, but as I said, that's often subsidized. Salary Finance is a provider of short to medium term installment loans to employees which are repaid from payroll, focuses on debt consolidation. The cost, it's only available in the UK today, although they're about to enter the US through an arrangement with United Way. Cost is about a third of what an open market loan would be. That's because it's repayment is coming out of your payroll, so it's essentially very low risk for the lender. And the impact of these is quite significant. So the employees who use the PayActive product on average experience a 19% reduction in turnover rate as opposed to those who sign up for the product and don't use it. This is primarily the young employees that employers are interested in retaining. 90% of the PayActive users are under 40 years and earn less than $15 an hour. Salary Finance, even better numbers, a 44% reduction in turnover rates for those who use the Salary Finance product, for those who don't. And again, 60 to 70% of them are younger, and 80% of them earn less than 30,000 pounds a year, which is about 45,000. This is a little hard to see, but I just sort of applied this to Walmart, where Walmart costs, by estimate, about $3,400 per employee every time an employee leaves. That's the cost of replacing that employee. What do you think the annual rate of attrition is at Walmart? It's 50%. 50%. So they have 1.5 million employees in the US, so 750,000 of them turn over every year. If we just take that 19% number, that would say they would have a reduction in annual attrition of 142,000. That's worth $474 million to Walmart. These are big numbers. If we applied the 44% turnover that Salary Finance was able to achieve, that would be more than $1 billion in hard cost saves for Walmart. So, you know, why doesn't anybody know about this? Well, Walmart has noticed, and they've, as I mentioned, started a deal with Even, which is now providing financial management software, and PayActive, which is doing the advance work. And they've, at the end of last year, they introduced it in the employee base. So really the proof is going to be in the pudding. If this works, then I think you'll see it being adopted in a lot of other places. I'm very hopeful that it will. I don't know what results they're getting, but that is my hope. So, you know, we've got a polarized situation here politically. Let's try to change the discussion by moving away from the government intervention versus non-government intervention argument, and pushing the employer channel as the way to change away from the currently damaging short-term system to something which is hopefully a lot better. So thank you very much. Oh, thank you. My non-digital version.
So I'd like to thank the speakers for two really, really excellent presentations. Thanks so much. They were both terrific. I was sort of struck by the contrast in the, Tomas's was sort of showing that fintech firms actually charge more sort of a convenience premium. They're hitting a far more affluent part of the population. Todd was talking about the potential for the short-term small dollar credit and sort of the very optimistic results with the pilots that are out there. So with that, let me actually open it up to audience questions. We're running mics for those in the room. Those online can actually just send an email to events@urban.org. Again, events@urban.org with your questions. So why don't we start with you?
Haven't even asked the question yet. Josh Silver, National Community Reinvestment Coalition. Mostly a question for the researcher from Harvard. The experience, I think, with fintechs is uneven. And I think that's a fair statement. And what I know about fintechs in the small business lending market is not so happy. That if you look at Federal Reserve surveys, that more customers are dissatisfied with loan terms and conditions of the fintechs that make small business loans than traditional banks. And I didn't see a whole lot in your PowerPoint presentation about loan terms and conditions. Mm-hmm. The two companies you highlight at the end, not much familiar with them. They look okay, but to what extent have you looked at loan terms and conditions of the fintechs, especially before you start recommending them? Are they in fact better than the payday lender or the overdraft?
Well, some are and some aren't. So the two examples of the credit improvement lenders that I mentioned in passing, LendUp and Elevate, have and it's important to understand what they do. They start out with an improved payday product with better terms and conditions, and their theory is that as you pay off your first couple of payday loans, they then migrate you down into a less expensive product with even better terms. So the question for these lenders is, can they prove that they are in fact facilitating a significant amount of migration upward to better terms and conditions? Because their base offering is better than a payday loan prior to CFPB regulation, but it is still very high cost. And so with them in particular, the question is, can they show that the model is actually working to bring significant number of people into what I would call the traditional credit economy? And part of what they're doing is they're reporting results to the to the credit bureaus. Because one of the oddities of the payday system is the credit bureaus never saw that you paid off your payday loan. So what they're trying to do in part And they are particularly, LendUp would present itself as a mission-driven organization. They're trying to bring as many people as possible into the normal, although still relatively expensive, credit market for under 36% type loans eventually. So our challenge is looking at them to see whether they can succeed in doing that or whether they are in fact just a somewhat superior version of payday lending. With respect to the earned income advance folks, I think it's hard to argue that that's a better alternative and a way cheaper alternative. It does work. It is based on an anomaly in the way we do things, right? Because if we move to instant availability of earned income, there would be no need for these companies. But today, because everything's on a 2-week or 1-month lag, they can provide a significant alternative. It isn't a panacea. The panacea is providing people with adequate income to support living costs in our society. So I'm not presenting these things as something that can really resolve the core problem. But there is a significant liquidity issue outside of that, which they can help.
Barry.
Excuse me, Barry Zegas, Consumer Federation. Tomasz, just a quick question on your data. You noted that the fintechs seem to be much more heavily engaged in refis, and I was curious if you had been able to parse out to what degree is it cash out refis or rate term refis, and to what extent is that a result of push marketing or pull marketing? Or I know there's consumer demand or the fintechs latching onto the customers and churning them.
So we've seen both in the data. So they do also a significant amount of cash out refis. It's hard to distinguish with this kind of data demand from supply, but anecdotally, and it seems like the push marketing is very important because since these companies do not retain these loans on balance sheet, and many of them are sold in TBA markets, so in some sense, the buyers don't even know these are fintech loans in the pools they buy. What essentially happens is they have all incentives to get as much transaction as possible. Now, whether it's good or bad for borrowers, it depends, right? Because there is something like an error of commission. If you refinance too often, it might just not be rational. On the other hand, sometimes borrowers don't refinance when it would be beneficial for them to do. But definitely the speeds of refinancing are so high that it's hard to argue that it's just because of borrower selection. And my experience talking to, for example, Quicken borrowers, they get bombarded by emails. Once you get these loans, you will get every other time, like, look, the rates are still low. You can save exactly that much if you refinance. And again, they face no cost in terms of the balance sheet. It's going to be borne by the investors and all the benefits of getting a lot of transactions.
Sam, and then in the back.
Thank you. So one comment to follow up on Barry's, because that was my question. The history of high-cost refinance products is that they tend to be predatory. Subprime in the mid-2000s, VA loans right now, you're seeing a lot of VA to VA churn, non-bank stuff. They originate loans at above market rates, and then they bombard you a month later, 2 months later with, hey, I can save you some money if you refinance. So I'm a little bit worried. The other question, I thought you made a really interesting comment when you talked about the spread of rates for these fintechs, that it was much larger than their counterparts. Do you think that means that they are more able to perfectly price discriminate? Do you know what I mean, or more efficiently?
Yeah. That's a very good question. So what we show is that essentially, if you go to a fintech company, your mortgage interest rate on average, controlling for all observable, will be about 16 basis points higher, which on a $200,000 loans, it's about $300 bucks per year, not including the tax deductibility benefit of interest payments. So there are really two leading explanations. One is that these are just borrowers that they don't have time to go to a traditional bank or non-fintech banks, and they're willing to pay this premium, especially if they refinance. Refinancing quickly is beneficial, even if I have to pay a somewhat higher rate. And an exact alternative is that this is a very clever marketing in terms of price discrimination, in the sense that I might just be really better to figure out that in this specific area, I can charge these borrowers a little bit more. Maybe, you could imagine you could use information like at what time of the day you apply. If you maybe apply at 3 a.m., it suggests that you're a very busy person and maybe I can charge you a somewhat higher rate. We cannot really distinguish that. All I can tell you that the premium is higher for more credit-worthy borrowers. That's consistent with convenience interpretation, and people who really value their time, they say, look, I want to refinance my loan quickly, I don't have time for all this paperwork, and I'm willing to pay the premium. But it's also convenient, consistent with this idea that I might be really good in price discriminating. And that's something we want to dig deeper. I had some discussions of getting exactly into the pricing algorithms. All we know, they do something else than traditional banks, because there's much more variation in the interest rates they charge that is not explained by simple observables. Again, that could be consistent with some clever use of additional data in price discriminating, but we cannot fully, unfortunately, tease it out in this paper.
Yes, in the back.
Hi, Joseph Ershine from the Fed. Tomasz, I just had a question on when you're making the distinction between the regulatory burden on banks versus sort of the relatively less for the shadow banks, did you try to make a distinction between sort of the safety and soundness requirements of banks versus the consumer, like mortgage rules that the CFPB is? Because it feels like with the Dodd-Frank Act, there's more equal footing, at least on the consumer side, but I understand maybe on the bank, capital and liquidity stuff. So I was just kind of curious if you tried to break out, when you say regulatory burden, which type of burden are you talking about?
So in this paper, we haven't really done so, though you can see that on various measures, you see that areas when the traditional bank, for example, face more crisis area lawsuits. They face them at the national level, but if you are a bank that's actually more litigated than others, you're going to see an increase in shadow bank lending. If you are a bank, we did some tests on mortgage servicing rights. They're subject to a Basel requirement that essentially it's harder to treat your mortgage servicing rights as a high quality capital. And we see that indeed the banks that are subject to this regulation, they cut on lending. And in areas when they are present, you see growth of shadow banks. And also in this simple calibration, I show really the tightening, what our model says happened model combined with data says happened around 2011. And again, there's a bunch of things that happen, like Consumer Financial Protection Bureau, passage and implementation of Dodd-Frank, changes in Basel rules. And in this paper, we don't really distinguish. We have some work in progress that specifically tries to quantify impact of each of these things. So this is what we are currently working on.
One of the oddities of the data set you use with the 2007 on is that basically all the non-banks were destroyed. So every non-bank in your set are new companies with absolutely no legacy involvement at all, whereas all the banks had significant legacy risk associated with reps and warranties, et cetera, because if he'd gone back years before, the makeup of the non-bank sector did a complete turnover.
Thank you. There are a couple questions that came in online. For both of you, what are your thoughts on bank fintech partnerships as a potential mechanism for facilitating more responsible lending for subprime borrowers, and then also for other types of lending, that is for borrowers that need access to credit but don't have the necessary credit scores?
So I would say that the banks remain fundamentally uninterested in this business. They may be convinced by pressures of various types to play in the business, and if they do so, they're carefully looking at the question of using alternative credit and other credit inputs and other things to try to do that. There are many partnerships going on now all over the fintech space. A good example, someone mentioned the small business lending, is JP Morgan's OnDeck partnership, where OnDeck's online origination engine is being attached to JP Morgan's credit standards to generate very small business loans for JP Morgan. But the banks are unlikely to move down the credit spectrum significantly without being pressured to do so, notwithstanding the availability of fintech products that might allow them to do that. So I don't see anything happening significantly that would change that mix. Banks are buying fintechs all the time. Goldman Sachs is picking up fintechs and fintech teams to try to turn its Marcus lending product into a more customer-centric business model. And you see other banks doing partnerships because it's often cheaper to buy a developed product than it is to develop yourself. And I think we're going to see that continuing in the race of the larger financial institutions, which are now catching up with the technology investment that they couldn't do when they were spending all their investment dollars on regulatory compliance. They're now competing much more actively.
I think in the mortgage business, the banks are definitely interested. I talked with some senior bankers why you haven't done it yet, and the two reasons they gave me is first, we have this investment in brick and mortar lending technology and labor unions and employees, so it's very costly for them to suddenly change their business model because that might require closing a lot of branches, but have some other benefits to them. And secondly, there's an interesting intersection also of regulation and financial technology. So from the Berk perspective, think about robo-foreclosure scandals. There's a little bit, the regulatory arbitrage benefit of shadow banks also potentially applies to technology adoption. Because in some sense, it's maybe more risky, say, for Bank of Americas of the world to start using online technology, which could be also subject to potentially some regulatory risk. This being said, my perception is given the current situation of the market, if they adopt it, they would mainly focus on serving better quality borrowers and trying to squeeze some margins. They might not be necessarily inciting as much refinances, especially if they keep these loans on balance sheet, but they might generally try to find ways to either, extract a little bit extra, few basis points by some clever usage essentially of this technology in pricing, or simply offering some of the borrowers convenience for which they are willing to pay. But given the regulatory structure right now in the US, it doesn't seem to me it will unlikely benefit like minority or less creditworthy borrowers to the extent of these other products that we just heard about.
Another related point is that the banks are putting on balance sheet only jumbo loans, right? Because there's an apples to oranges thing here with the Fannie Freddie stuff, which is all homogenous. So to the extent that banks are putting anything on the balance sheet and subject to capital and regulatory burdens, it's high-end mortgages, jumbo mortgages above the Fannie Freddie limits.
Well, let me actually I'll use my prerogative and ask a question which sort of follows up pretty nicely, and that is, for the traditional fintech lenders in the mortgage space, you showed, Tomasz, how rapidly they have grown over the last few years. I mean, it's been incredible. Sort of looking forward, refi activity dries up substantially. Furthermore, the better quality borrowers were those that have already refied 4 times and can't benefit, when rates go up even a little bit. So what do you think becomes their growth engine? Do they begin to go down in credit quality a little bit, or what do you think, or do they just sort of try to contract their growth rates and not worry about it?
They already do in some sense. So first of all, they still do a substantial portion of purchase loans, and they're still very active in FHA market. For example, Quicken is a very important lender. They're not geared as much to FHA market as other non-fintech shadow banks, but they are. And I think from the taxpayer perspective, there is a somewhat worry in that sense. These are institutions that have a limited capital, and they are very active in a market with a very considerable government guarantees. As we all know, FHA market is essentially a market virtually with no down payment, when core risk of the default is assumed by taxpayer. And essentially, it's a little bit coming back to this balloon theory that we've heard very nicely. You pressure traditional banks, it's going to pop up somewhere else with even less regulation.
Although it's worth mentioning that I think online technology is being universally adopted. It's just slow. Rocket Mortgage is way ahead of that, but other mortgage banks are trying to get, in the eternal effort to cut costs, they're going to invest in technology and hope they can get rid of people. And the banks themselves, over time, those that are staying active in the mortgage business, the Wells Fargos of the world will move more and more in that direction. So it's ultimately, artificial intelligence and online delivery are where the entire industry is going. This is just a period in which there are a group of companies who are considerably ahead of the game.
I think there is a question all the way in the back, and then Barry after that.
Good evening, Omar Almy from Onward Financial. My question is kind of on partnerships. You saw 2009 to 2012 fintechs wanting to break banks, and then partnering with banks since then. How do you see that evolving in the next 5 to 10 years, whether with regulation change or not in the U.S.? Because
the idea that fintechs were going to fully disrupt the business, it was, a fantasy of the venture capital community. And if you looked at the predictions of where online installment lending of Lending Club and Prosper type was going to go, if you looked at what people were saying 3 or 4 years ago and compared it to what actually happened, you'll see that in fact, those predictions were wildly optimistic. The banks are now responding. They have significant advantages in the U.S., particularly because of the regulatory structure, their incumbency advantages. They're using them. Interestingly enough, in Europe, as an industrial policy matter, the EU has decided to eliminate most of those advantages and encourage the fintechs to be disruptive. That's not the case here, and the banks will use that advantage as much as they can to try to win in the long-term game. That doesn't mean that the fintechs can't be significantly successful, and some have already been so. It's really a question of what type of exit a venture capitalist gets when they invest in a fintech. Is it going to be a company like SoFi would like to be, the private bank for the millennial generation and just grow to become a giant company, or is it going to be a company that sells out to another bank or another financial institution for a very nice return, but doesn't operate independently? And I think we're going to see a mix of those things as we always do, but a lot of the hype coming out of Silicon Valley around fintech is now more muted.
Barry, and then the last question goes to. Oh, okay. Barry is uncharacteristically yielding.
Thank you, Barry.
Thank you, Barry. You go.
Hi, I'm Stella Adams with the National Community Reinvestment Coalition, and this question is for Tomasz, related to your county level shadow bank share. And I was wondering, since you only did 2 maps, did you find that the fintech share looked very similar to the shadow bank share, and that's why you didn't break them out as you did the different products? Because I do note here that if you look at the shadow bank share and you look at a poverty map of these 3,000 counties, they would be very, very similar. And I was wondering, are the fintechs operating in the same markets as the shadow banks, and that's why there was only 1 map?
Thank you for asking. I mentioned it a little bit in my talk. There is actually important difference. So in our case, both fintech and non-fintech, generally shadow banks are more active in minority areas because they are really dominating FHA markets. And FHA also is a good predictor of lower credit worthiness, minority status. They're also active in higher unemployment areas. If I would do the map only for fintechs, they generally gear towards better, the higher income areas with higher education, and that's sort of consistent with this idea that they tend to specialize more into serving more credit-worthy borrowers. And in that sense, we haven't found really a mounting evidence that these fintech mortgage lenders help democratize credit, for example, to minority borrowers that maybe feel a little bit uncomfortable going to traditional banks. But just to be a little bit careful, it's hard to say if it's demand or supply, because it could also be that to apply for for example, Quicken Loan, you need to have a certain amount of financial savvy. You need to be able to go through an application process online. You need to have a good internet connection, and that could be a barrier to some borrowers to apply. So it's not obvious whether it's supply or demand, but the map would look differently for fintech.
Just a brief follow-up, Barry, I'm sorry. But if you think about most of these high poverties are also very rural and are in digital deserts. And so we're really talking about, do they have access to the fintech?
Exactly.
Do they have access to the models? And if the only product you have access to is a FHA, even if you qualify and would consider a conventional, if there's no branch there and the only thing is a shadow bank, that's the only option you have.
Yeah, and that's sort of very consistent with what we find. And traditional banks, just to add to it, might not be very willing to serve these communities because of regulatory risk, litigation risk, and so on. These loans are all insured by government in terms of default, but there's still a risk that if they start defaulting at a high rate, you will be sued by, say, FHA, while the shadow banks don't seem to care as much about that because they can just always, as precisely the point was made, go bankrupt because they don't have very deep pockets. They can pay most of the profits through some form of a dividends to the shareholders, and when something bad happens, they may just disappear, which again is a considerable risk for the stability of the mortgage market, because if we have a next crisis and most of the loans are made by shadow banks, including conforming loans and FHA loans, that's going to be a very interesting situation.
That's also, I think, relevant to the small business question, because to the extent that fintechs and non-banks take a bigger part of the small business lending, they are more vulnerable in a downturn, and you might find the access to credit being cut off just at the moment that you really need it.
Barry, the last question is yours.
They walked right into it. Barry
And
Zegas.
then we're going to move over, and drinks are in the next room. Remember, our next event is April 11th. So, Barry.
Tomasz, I just wanted to comment on the language you use in your paper and make an observation that when you describe it as regulatory burdens or reimposition of regulatory stuff, it sounds negative. Just think about if you said the reestablishment of prudential standards for lending has been applied, and somehow there's this group of lenders who aren't under the same prudential standard. What does that mean? Might change the way people hear what you have to say. I just want to make that observation.
I actually very grateful for your point. We try to be careful, but maybe not careful enough not to make welfare statement in the paper. We're just looking, okay, if the banks first more regulatory constraints, they're gonna lend less. Given that most of these loans are insured by taxpayer, it might be a very good idea in principle. This being said, coming back to this balloon analogy, what really happened, we regulated a lot the banking sector, potentially in a hope to avoid the problems. But this being said, in some sense, the lending has moved to the lightly regulated institutions. So even if this regulation was good in the very first place, it's not obvious that it achieved its objectives, even if you take this step. But I'm really grateful for your question. I didn't want to give you an impression that we view regulation necessarily as a bad thing, and we're very careful. We don't say it's good or bad. We just want to describe market trends, and we say traditional banks really cut lending largely because of regulatory burden, but that doesn't mean this regulatory burden is bad necessarily from the social welfare perspective.
I think actually, why don't the speakers will be up here for a few more minutes. They'll be around for a few more minutes. I think we're going to open it up to cocktails now. Thank you all very much, and thanks especially to our speakers who did a wonderful job.